Hello everyone, and thank you for taking the time to watch this demo. My name is Connor Booth with Huron Consulting Group, and today I'll be showing you a basic version of our higher education long-range planning model within strategic modeling. The areas we will cover today are typical within higher education forecasting, but keep in mind that these models are configurable to your institution's needs. To get started, there are two methods in which users can access strategic modeling, through the web and through a SmartView Excel admin. I'll briefly show you the web interface, and then I'll do the majority of the demo within the SmartView admin. The reason I do this is because typically clients prefer to see things within the SmartView admin, as they're typically coming from an Excel-based world, and it looks and feels more familiar to them. Starting with the web, this screen should look familiar to you, as strategic modeling is one of the modules within Oracle's Enterprise Planning and Budgeting Cloud Services, and can be accessed from the home page once it is enabled. I'll start by clicking the strategic modeling cluster and going into the model view here. Here on the screen, we can now see all models that are available for a user within a specific environment. To access a model, users can either check it out, which means that they have it locked for data entry. Once a user is done with checking it out, they can check that model back in, and any changes they made will be saved for all users that have access to that model. The other option is opening as a copy. The user may want to open something as a copy if they just want to view a model and see certain outputs, or if they want to test out entering modeling assumptions but don't necessarily want to save them. So here I'll open this as a copy. This is the web interface for strategic modeling. I'll start by going to the account group drop down and selecting a specific account group. Account groups are logical groupings of accounts that are configured to facilitate a more seamless modeling process. You notice in the left-hand column, we have account numbers that are unique for each individual account within the model. In this column, we have account names as well as account forecasts. This top row is an account name. Anywhere you see blue is an account forecast methodology. In the row along the top, we have our time periods. The ones in black are historical periods. The ones in blue are forecast periods. You see we have a white row here. That's for inputting an assumption. Gray row is the output. Anytime you see an account that's bold and black, it doesn't require any input. It means it's just a calculation. In order to make a data entry, you simply need to select a cell and type in your assumption. After I change this from 2 to 3, you see that the cell is changed to yellow to show that I've made a change. Once I click Save and Calculate, every output row that was impacted by the assumption I made will also highlight yellow. This is a summary group, so I can actually even go down to our net tuition and fees account and see that it was updated from our assumption up here. Now this is a summarized undergraduate net tuition and fees account group, or a group of groups rather, as this is just a collection of these individual account groups. Let's say I want to go into undergraduate enrollment now, as I've already made a tuition rate growth change. Now we can go to enrollment. Now, when I mentioned earlier that these models are configurable to your institution's needs, I can give you an example of that right now. In this demo model, tuition is forecasted as enrollment times a blended tuition rate per head count. Now, some universities may factor in credit hours. Oftentimes what we'll do is we'll still forecast out enrollment, have a average credit hours per student to get to a total number of credit hours. Then we have a tuition per credit hour rate, multiply the two of those together to get tuition. So that's just an example of how you can get to the same end result by different modeling processing for your specific institution's needs. Now we'll see here, if I expand this row a little bit, we'll see that our sophomore enrollment numbers are forecasted as a percentage of our freshman enrollment numbers in the prior period. So if I were to make an update in this row here, say I change that to 150, I save and calculate. This now impacts a number of different accounts. Similarly, junior enrollment is forecasted as a percentage of the sophomore enrollment, and so on. I flip to our net tuition and fees summary group. Our net tuition and fees are being forecasted as a result. If I were to click on an output row here, then I want to see how that account is calculated. I can go into Actions and Audit Trail In. This allows me to drill into the calculation and see what this number is made up of. So you can actually continue to drill in all the way down as far as you can go, even to the input level. So as you remember, I just changed this number to 150. If I change that back to 100, close out of this, and calculate again, the number went from 438 million to 437. It's a minor change, but we can see that the impact of those 50 headcounts that we made updated all of these accounts. Now I'm going to get out of the web view for the rest of this demo. As I mentioned, I think users are typically more familiar and prefer the SmartView web interface, or sorry, the SmartView Excel interface, and I'll do the rest of the demo from there. Now, in order to access strategic modeling through SmartView, users will access it in the same manner that they can access PBCS or ePBCS. I go to Panel, under our SmartView ribbon, and click Share Connections. I could log in from here. Once I log in, you'd see the same link to your environment show up in the panel here. You can just drill into the cube that you're working in, and you'll see a strategic modeling drop-down menu from there. For demo purposes, I'm going to stick with the model that I have saved locally. So here you see on the screen, this is the interface for the SmartView extension. You notice we're in the same account group that we were in the model within the web interface. Now, when users are actually connected to their PBCS or ePBCS environment, they will be accessing the exact same copy of the model that they would within the web. They are always in sync as long as users are checking them out, entering assumptions, and checking them back in to be saved. Now, we looked at net tuition and fees within the web interface. I'm going to focus on a couple other key modeling areas for you today. We already looked at undergraduate net tuition and fees, which is always the biggest revenue item for universities. Personnel costs typically are the biggest on the expense side. Now, what we typically do within our models is we forecast out our personnel headcount using a target student to faculty ratio. And you see in our account description here, we've used a custom freeform formula to write here that solves for this ratio in history. That's where you see this backsolve in history. And then we enter a change in forecast. So let's say in history, we have it solved for 10.7 as a ratio of student to faculty. So I think we have room, and our target is more around 11.5. So we want to increase our enrollment without necessarily having to increase the faculty headcount. If I were to enter 0.8 right here, I go up to data and click calculate. This output will update accordingly. And it flows through into all forecast periods. Similarly, if I were to enter a small adjustment downwards, calculate again in one of the subsequent periods, those will continue to flow through as well. So we increase by 0.8 within FY 2018, and then decrease by 0.3 in FY 2019. You see our faculty headcount target has updated accordingly in each period in relation to the increasing enrollment that we show in each of these periods. We've forecasted out our target faculty headcount. Within this account group here is where we can look at a blended average salary and the overall salary expenses. Oftentimes we'll factor in a global driver here, this merit or base salary increase percentage. Here we have a flat 1.5% increase year over year. Let's say the university performed exceptionally well financially in the year prior. We're very happy with our faculty, and we want to show we're giving out an increase in our merit increase this year, because we want to factor in retention for key faculty. So if we update that to 2%, again, we'll calculate, and we see that will go through as well. And oftentimes we break this out between faculty and staff. You can have any level of detail in here as well. We oftentimes see faculty broken out between professors, adjuncts, lecturers, TAs, or graduate assistants. And then we can have any level of detail within staff, headcount, and salaries as well. We'll now go down to our faculty fringe rates. Again, oftentimes we'll take your historical information for faculty salaries and faculty fringe benefits. So we'll load those numbers in history. Now, the percentage of your fringe benefits costs as a percentage of your faculty salary may not be a number that you just typically have offhand. That's one of the benefits of loading this data into strategic modeling, so we can solve for that percentage in history. So again, we still have that audit trail capabilities. If I drill into this, I can see in history we're taking fringe benefits for healthcare divided by our faculty salaries, and it solves for that percentage, 19.4 roughly. And again, we can use our input adjustment in forecast to make adjustments to those rates as we see fit. There we have our rates. If I go down to the next account group, here's the associated expenses. Again, these account groups are all configurable. So if users would prefer to see the associated percentage with the dollar amount output right below it, we can configure these account groups to kind of show that flow of accounts, however the specific institution wants to see it. Now, I mentioned before that, I may have mentioned before that one of the biggest value adds, personally I think the biggest value add for strategic modeling is its fluid scenario analysis capabilities. Now, typically in an Excel-based world, if users have gone out and they've developed their base case, they want to start running what-if scenarios. What if we increase enrollment by X percent, or if tuition rates were to increase by Y percent? Or if we wanted to, if our faculty salary costs start to decrease, how does this impact our financials? In order to do that in an Excel world, you need to create a copy of the workbook that you developed all these base assumptions in, maybe copy a couple of tabs over, make sure that those original linkages are still in place, and then start to develop your what-if forecast from there. At best, this is an inefficient process, and at worst, this can be a highly inaccurate process. If these linkages are broken, or if you accidentally key in a number in an area you didn't mean to, you can get highly inaccurate data from working solely in Excel. The nice thing with strategic modeling is you can create a new scenario on the fly with this scenario button up here. We have a couple of pre-populated ones here. I'm going to create a new one. Let's say we're going to call this Enrollment Increase. Scenario to copy from, I'm going to select base. What that means is that we're going to inherit all of the assumptions for every account in the model from our base case scenario, except for any specific accounts we choose to flex within the scenario. You can also leave comments here. If there are going to be other users that are active in this model, you may want to leave some additional information for them about which specific accounts you're using. So we could say this scenario is meant to show increases in freshman, sophomore, and junior enrollment. And click OK. Now you can do a standalone scenario where every account is available for input. But typically what we see, we use inherits. You notice right here, this updated to show that our enrollment increase that we just created is inheriting our base assumptions. Now I can search for specific accounts that I want to update. If I search for enrollment, as I mentioned in those comments, we'll look at freshman, sophomore, and junior enrollment. Now click OK. Now you may or may not have noticed in the top left drop down over here, it automatically updated from our base scenario to our enrollment increase scenario. You also will have noticed that every account on the screen is now grayed out. We didn't select any of our fringe benefit accounts as ones that we wanted to flex during the scenario, so we no longer have an ability to input. This is where you get the assurance that any incremental impacts that you see between your base case and this new scenario are only from those accounts that you selected in Scenario Manager. And from here, I can either flip back to my undergraduate enrollment account group, where I know those accounts reside, or strategic modeling also automatically populates a current scenario only account group for you. So if I flip there, this shows just those accounts that I selected. This is really helpful if I was going to be modeling out a scenario that may factor in accounts that reside in different groups. Say that I wanted to model out enrollment, tuition rate increases, and housing rate increases. Those all reside in different account groups normally, but if I go to current scenario only, I'll see all those accounts showing up here. Now, this is enrollment increase, so let's say I'm updating these numbers to be 150, 125, and 100 in these first three forecast years. I'll also say that we have a higher retention percentage for our sophomore class and our junior class. One of the nice things about operating in the SmartView version here is that it still maintains some of the Excel capabilities. So if I were to type in, let's say 96% right there, I can highlight that cell and copy it and paste it. Similarly, I could highlight that cell and use this little bottom corner button to drag that assumption over and populate there as well. And if I calculate, you see that our outputs have now changed. Now, if I were to go to our undergraduate net tuition fees summary, I could toggle back and forth between our enrollment increase scenario and see that we went from, in our new enrollment increase, it's resulted in 320 million, 341 million, and 358 million over our original 313, 326, and 333. I can also go into one of our reports down here. These tabs along the bottom are all individual reports. So if I go in our scenario variance report, what this report shows is the difference between the scenario that we have selected in the top left corner and our base case scenario. Right now, this is showing base versus base because I have base selected up here. So the variance between those two is obviously 0. Those contain the same values. If I flip to our enrollment increase, click refresh, then I'll see those variances populate. So as a result of increasing our freshman, sophomore, and junior enrollments in those years, we're seeing increases in net tuition and fees, auxiliary income because our housing revenue is tied to enrollment, and also some of our personnel costs. As I mentioned, we use our target student to faculty ratio as a driver for faculty headcount. So as our enrollment increases, our faculty headcount increases, and our personnel costs increase as well. So although we only selected those enrollment accounts to flex during the scenario, it still holds the same linkages that you see within the model, and it updates the other outputs. We know that we didn't make any inputs within our personnel accounts to make these changes. These only came from the increase in enrollment. The scenario variance report we also keep for full balance sheet and cash flow as well. Now, another note on reporting. If I flip over to our SOA functional report, you see again we have our account numbers in the first column, our account names in the second. We no longer have the account forecasts because these are reports, these are meant to be easily distributed to anyone that may not have access to this system. One nice function here, though, we can still use our audit trail. So if someone does have access and you are looking at these reports within the system, you can still audit trail in and see the calculations. I can look at tuition and fees, and continue to drill down. And again, I could go all the way down to the input level. So in this year, we changed it to 125. So I wanted to change that to 150. Close out, calculate again. And the numbers will have updated in our forecast years. Another thing we can do, we have the specific scenario variance report. However, you can also add variances into any structured strategic modeling report. So under alternate report format type, I could show currency and a growth rate. If I apply to the current report and click refresh, we're showing the currency actual value of that account in that year and the year-over-year growth rate for those accounts. And all this was done just with the click of a button up in reports. Now, I want to show a couple of key modeling areas. Within our hired application, or sort of a starter template that we have, we've built out robust gifts in fundraising model functionality. So what this allows you to do, then again, this is a configurable part of the model. Some institutions, particularly larger institutions, will look at gift and fundraising activity from a campaign perspective. So you want to set a campaign target over a certain number of years and be able to model out the necessary gift and pledge activity to reach that campaign. For smaller institutions, a full campaign-based gift model may not be necessary. And we've also built in functionality about just inputting pledges or growing pledge activity and gift activity as a growth rate. Again, all this is configurable based on the specific institution's needs. But what I'll show you here is the campaign modeling. So I've already pre-populated a little bit of data in here. Let's say that our campaign, we're going to start it, and this model is a little bit outdated. Let's say that it started in FY18, and we're going to end this campaign in FY 2020. I input those numbers there. Let's say we have a campaign target of, currently it's set to 60. Let's update this to 120 million. One thing to point out, just to show that it is in thousands here, that's because the scale of these accounts is in thousands. Again, this is something that can be configured on an institutional basis. So I changed that to 120. And click calculate. You see this pledges per year is automatically calculated based on the number of years remaining in the campaign and our overall target. So this automatically spreads it to 40 million per year. Typically, we have 3 flavors of gifts that we include within your gifts for current use or operational gifts, gifts to the endowment, and gifts for capital. Automatically, this plugs all of them 100% to gifts for operation. Let's say we think 30% of these are going to go to the endowment, 20% are going to go to capital. Normally, if we loaded in gifts activity in history, it would backsolve for these percentages and then trend them forward in the forecast as we see this input adjustment. But this is reading this as, since there's no activity loaded in history, we're adjusting this number from 0 to 30. I calculate. Now to show you the adjustments, let's say in the next fiscal year, we actually think it's going to be 35% gifts to the endowment and 25% gifts to capital. Calculate again. You see the output rows have adjusted accordingly. So this allows you the flexibility of modeling out how your gift activity is going to come in on a year-by-year basis. We've also built in a few other drivers here. Number of collection years for these pledges. So right now, we're assuming that all of these pledges, 40 million in each year, will be collected over a 5-year period. We also, if you track any allowance for uncollectible pledges, you can enter that in here. So it may say that 2% we believe actually won't be collected. And what this does, this allows for If you're modeling out on a GAAP basis, this shows the true SOA impact, and also factors in a contributions receivable. So what this does, it automatically automates an allowance dollar amount, and then as this flows through in history and the model kind of forecasts out you receiving those pledges, it also writes off the 2% that we've entered in here. And similarly, to show a true SOA impact on this, technically pledges in forecast, when recognized in the SOA, are meant to be discounted back to their present value. So if we were to enter in a discount value here of 3%, again, both of these are input change in. And when I say change in, that means that it's trending forward like this, whereas if it was just an input, we would need to input that in each year individually. So if I enter in that 3%, any future pledges are being discounted back at that 3% rate to show what the actual GAAP SOA impact of that should be. Now I can flip to our gifts report and show some of the calculations in the background here. So this is a summarized look at the campaign we're currently running. You notice off on the right, we've also built in a second campaign. For particularly large institutions with a lot of gifts or fundraising activity, there are cases where they may be running 2 campaigns simultaneously that have a tendency to overlap. We've built in a second set of all these accounts to allow the ability to do so. And the summary here, we have our pledges per year. We built in an extra row to allow for any adjustments. Say at the beginning of a campaign, you may anticipate receiving higher pledge activity and lower towards the end. This allows you to kind of show that cyclicality of a fundraising campaign. Shows a summary of our assumptions here. And you can see here's our first assumption of 50% for operations, 30 to endowment, 20 to capital projects. And you may recall we entered those adjustments in the following year. We bumped this up to 35 and this to 25, which automatically downsized our operating gift activity to 40%. Now, these are, you see waterfall calculations. This is our first year of pledges being collected over that 5-year period. And you'll notice these pledges in the future years have that 2% of uncollectible factored in. Similarly, this is happening in the out years as well. So these are operational gifts, endowment gifts, and capital. Here's our total collection schedule. And our financial account summary. So this shows the impact to our SOA accounts. And here, contributions receivable impact. Now, the last section that I want to show you as far as key operational modeling is capital projects. The capital projects we typically do we model these out by useful life buckets. So more often than not, universities will have 4 or 5 useful life buckets that they'll model out capital projects in. Here you see 50 years for like actual buildings or major renovations. We use dimensions within here to apply an additional account structure. So what a dimension is within strategic modeling, instead of creating new sub-accounts to model out individual projects, we can use the same set of accounts and apply a structure to them that kind of simulates different capital projects. So this is not to get confused with dimensions within EPBCS. Strategic modeling does not sit on a multi-dimensional database. So there's not a intersection of various dimensions where this data sits at, as you might be used to from PVC or EVD plants. Let's say here that we're going to model out a new undergraduate dorm building. First, we're going to start off by selecting a go-live date. Let's say over the next 2 years, this dorm building is going to be built. So we'll say that it actually started in FY18 and it's going to be completed in 2020. If you started your strategic modeling while there is an ongoing capital project, you could enter in a historical CIP balance in history here. And the model is, you could just do any incremental modeling on that from that point on. Let's say for this dorm building, we anticipate spending $15 million in the first year and $10 million in the second. It's a really fancy dorm building because we love our freshmen that are coming in. You see that CIP balance grows by 15 in the first year, 25 in the second. You notice that the balance closes out in our go-live year. And these impact our balance sheet accounts. So I actually want to take a step back and make one note about the account numbers over here. You notice any account in the 300s is a memo account. This is something that we can use. These are configurable to be drivers in whatever way we see fit. So a percentage for tuition increases would be a memo account. All of our enrollment accounts or personnel head counts would all be done in memo accounts. We can also use these for custom ratios that are used just for outputs. You see our CIP balance is a 2180. So that means any balance sheet account is going to be a V2000. So starting from current assets, our cash is going to be V2000 itself, all the way down to our equity accounts would be somewhere in the V2800s. So it follows the account structure, follows your typical balance sheet format. Similarly, any income statement account or SOA account is going to be a V1000. So if you've been paying attention to the account numbers at all and had any questions about those, V300 or V300 through V395 is going to be a memo. V1000s are going to be statement of activities. V2000s are all going to be balance sheet. You may see some V400s in there. Those are custom ratios or output accounts. Now we also set up different sources of funding for this capital project. These, again, tie into our balance sheet. So we could choose, and this is configurable for whatever sources of funding your institution actually uses. Within here, again, this will automatically plug to cash, but you can enter in alternate funding sources as you see fit. So let's say we just modeled out gift activity. Let's say in this first year, we're getting $5 million of this is coming from gifts. $10 million of it we're going to pull from construction fund bonds. In the second year, we get another $5 million from gifts, but we'll let the remainder of that plug to cash. You see these outputs all update accordingly. You notice here, CIP closings have now started flowing through from our 2180, which is construction in progress, into our 2170, which is our actual gross fixed asset account. And you may see here, this 25.4 million is not the 25 that we had initially entered in there from this 15 and 10. Let's take a look and see why that is. We can audit trail into that and keep drilling into this calculation. Apologies, my computer froze there for a moment. As we drill into this calculation, into the CIP balance, and we go through, we read through our calculation, we see down at the bottom here, adding capitalized interest. So this capitalized interest is coming from the fact that we forecasted part of that spend coming from our construction funds. So any bond issuances that are actually used for capital projects, the capitalized interest that's paid on that is meant to be included as part of the cost basis for that asset, and therefore flows through in the model. We've created those linkages within this model that anytime we use construction fund bonds to pay for any of our capital projects, they'll flow through there into that cost basis for the asset. And if I scroll down to the bottom, we can see that our capitalized interest payments are coming in here. I'll scroll back up a little bit. In our go live year, the CIP balance is closed out and gone into our gross fixed assets. And now typically, when a new project goes live, we want to make sure that there are additional linkages set up into the SOA to make sure that with an increase in square footage of buildings on campus, there would typically be an associated O&M expense or utilities expense that should kind of incrementally add on as well. So here we build in accounts that allow you to enter in an assumption for what your O&M and utilities expenses will be as a percentage of that construction cost. Now we see a pink input row line here. That means that this assumption is held for all forecast periods, regardless of where we enter it. So if I think that this should actually be the O&M expense should really be 2% of this construction cost, regardless of what period I enter it in. Let's say 2021. Take that and click calculate. It now flows through for all periods. Down at the bottom, we have a summarized account group show, or set of accounts that show the percentage breakout of our funding sources used above. And these are the key modeling areas that I wanted to focus on today. As you see within this account group, there are a number of other areas that we typically will forecast out, particularly for higher institutions. And if you have a robust grant and contract modeling, endowment or debt-focused modeling, what the model will do, like I mentioned above, we have the construction fund bond proceeds, or that will automatically draw into our capitalized interest. You can enter in all historical debt information, whether it be capital project related or not. Regular debt issuances are included in here as well. You can use something called the debt scheduler to show new lines of debt. So I should take you through these quickly. I'll create a new debt schedule here. If you want to model out new debt in a forecast period, I can pick a start date in a couple of years from now. I can either pick an end date, or I can also enter the term on that screen there. I accidentally hit enter when I typed that in, so the screen went away. If I want to model out 10-year bond issuance, Enter the principal value here. Let's say it's a $25 million note. You can enter in any premium or discount. So there's a 5% premium. Issuance cost of 3%. And you can choose to have the model either expense the issuance costs as they're incurred at the beginning of the issuance, or they can be amortized throughout the course of the loan. And the model has what are called related accounts that track all of these balances. So the unamortized balance of issuance costs and the associated amortization expense, or the unamortized balance of a premium or discount, and those associated expenses will all be tracked and calculated by the model. So I'm not going to expense those as incurred. It will calculate the current portion of this long-term debt. We could set a matching schedule here. Say there's 2.5 million on the issuance day, and it automatically creates the payment schedule for us here. Users can also go in, and if it's not an evenly paid off schedule like this, you can enter in any actual customized schedule that you have as per your loan package. If we go back to the payments tab, we'll see that the payment schedule that was created completely pays off the loan. We can also enter in any interest information. So you can choose to do a 360-day or a 365-day interest calculation. You can select the day of the month. This loan was issued on the 15th. We say we're also paying interest on the 15th. You can have a variable interest rate, which you would actually enter on the account screen in the background, or set a constant rate. You can also choose to set this as a spread over another account. One thing that we've seen clients do in the past is create a custom memo account using one of those V300s to forecast out what, say, a LIBOR rate might be. If you have a loan issuance that's tied to LIBOR, you can enter in your own assumptions of what LIBOR would be, and then have this interest rate entered in as a spread over LIBOR, as an example. I click OK. And go down into our debt account group. Let's actually find an account group that's specific to just the one that we created here. So go down to an account group that I just created. To show this issuance. So we had some leftover data that I just deleted there. We now see if we look out in forecast, it shows us issuing that debt in 2021. And these are all related accounts associated with the issuance. So it tracks our scheduled payments, which shows the balance decreasing. It shows the interest based on the 2% that we entered. I can continue to scroll down. It shows our unamortized issuance costs and the associated expense. Similarly, their premium discount and the associated expense there as well. And lastly, here's the current portion being calculated in each period. Again, as I mentioned, there are a number of other focus areas that we can have robust and configurable modeling around, whether that be grants and contracts or endowment modeling or anything other that is specific to your institution. Those things to be vetted through in a requirements gathering session and then further developed during design meetings. That's all I had for you guys today. I want to thank you for taking the time to watch this demo. I hope this was valuable information for you. If you have any questions, please reach out to your contact person with your own. Thank you.